Welcome to Big Picture Earnings Analysis. We are jumping straight into Kroger's Q3 fiscal year 2026 results. And it's a really complex one. We saw a modest adjusted earnings beat, but a revenue shortfall that, created some friction in the market.
Right, but then they turn around and raise their full-year guidance. It's that contrast that makes this release so important to understand.
Okay, let's start with the hard numbers that hit the wire. On the surface, the adjusted results were a win.
They were. Adjusted EPS came in at $1.05, which was just ahead of what analysts were expecting.
$1.03, I think, so about a 2% surprise.
Exactly. And that represents a solid 7% year-over-year growth. Operationally, that's healthy.
But the top line, the revenue, that's where the concern really started.
That's the number that spooked investors.
Yeah.
Total revenue was $33.9 billion, and the street was looking for something closer to $34.3 billion.
And that miss was enough to send the stock down pretty hard, over
Yeah.
5.5%.
It was. It just shows you how sensitive investors are to sales momentum right now.
But if we drill down a bit, the core metrics, like identical sales, they actually look pretty strong, right?
They do. Identical sales without fuel grew 2.6%. And more importantly, the two-year stacked growth hit almost 5%, which shows really consistent momentum.
And their operating profit.
Also very strong. Adjusted FIFO operating profit grew 7% to $1.1 billion.
Okay, we need to pause there for a second. We hear adjusted and FIFO all the time. Can you just give us a quick frame for why those are the numbers management focuses on?
Sure. So FIFO, first in, first out, it's an accounting method that basically strips out the noise from changing product costs. It gives you a clear picture of store profitability.
Okay.
And when we say adjusted, we're taking out one-time non-recurring events, which is why the adjusted numbers look so good. They show the underlying business is healthy.
Which brings us to the elephant in the room, the non-recurring event that absolutely pulverized their GAAP results.
Precisely. If adjusted results show the day-to-day health, GAAP, the official accounting, shows the full picture, failures included. And the Q3 GAAP results included a massive $2.6 billion impairment charge.
A $2.6 billion write-down. That is a staggering figure. What was that tied to?
It was almost entirely tied to their automated fulfillment network. It was basically an admission that the strategy wasn't working.
And that charge created a huge loss on paper.
A huge loss. It resulted in a GAAP operating loss of over $1.5 billion and a GAAP EPS of negative $2.02.
So this was management just decisively cutting bait on the very expensive mistake.
It was an essential radical cleanup. They're signaling to the market that they're moving on from this high capital, low return approach.
So they took the financial hit now to clear the way for the future. And that directly ties into the updated guidance they released.
It's the only way the guidance makes sense. Despite the huge GAAP loss, they raised the lower end of their full-year adjusted EPS guidance, narrowing the range to $4.75 to $4.80.
And that confidence.
Yeah.
It sounds like it's entirely tied to the massive e-commerce shift this write-down enables.
Exactly. They did a full strategic review and concluded that 3 of their big automated centers were just not meeting expectations. So they're closing them.
And what's the financial target attached to taking all that pain?
The payoff. The move is expected to contribute about $400 million in incremental e-commerce operating profit in 2026.
Wow.
And they stated this is what finally positions their entire e-commerce business to be profitable next year.
Okay, let's just connect those two numbers for everyone listening. They take a one-time $2.6 billion accounting loss this quarter.
Right.
To unlock a $400 million profit improvement every single year starting next year.
That's the trade. It shows a huge prioritization of operational agility over just, owning big, expensive buildings.
So if they're ditching their reliance on these robots, what are they betting on instead? How does this new hybrid model work?
They are doubling down on what they already own, their massive 2,700 store footprint. And by expanding their partnerships with third-party providers, think Instacart, DoorDash, Uber Eats, they cut their capital needs and instantly get more speed and coverage.
The speed factor is huge. Delivery in as little as 30 minutes.
Exactly. And they're already seeing proof it works. The DoorDash partnership fulfilled 1 million orders in the first month alone.
1 million.
And it's attracting new, younger customers who want those quick, small basket orders.
This integration with partners must also create new opportunities for their alternative profits business, like digital advertising.
It does. Their media business had double-digit growth in Q3. And connecting it all back, that $400 million profit benefit It's not just going to sit
They're
there.
going to reinvest it.
Reinvest it into customer value, so better pricing, better experiences, while also improving their own operating margins.
Let's shift focus a bit to the consumer. What did management say about how their customers are behaving right now?
We're seeing a real split in behavior. Higher income households are still spending strongly, but they noted significant pressure on middle income customers.
And how is that showing up at the register? Are they trading down, buying less?
Both. They're making smaller, more frequent trips to manage their cash, and they are definitely cutting back on discretionary, non-food purchases. General merchandise actually comped negative.
And there was a temporary headwind from SNP benefits, too.
That's right. A pause in SNFP distribution late in Q3 added a bit of extra pressure to their sales. It just reinforces how critical value is for their core customer.
So with a cautious consumer, what's protecting their margins and keeping that adjusted profit so strong?
Two main things. First, the incredible performance of their private label business, what they call our brands,
They continue to outpace the national brands.
significantly. And what's crucial is the growth is strongest in their premium lines, like Simple Truth and Private Selection, so they capture those high-margin sales.
And the second key driver?
The pharmacy business. It was fueled by strong core prescription volume and, of course, the continued tailwind from the GLP-1 weight loss medications.
Right, the Ozempic and Wegovy effect. It's a huge traffic driver.
It's major. People come in for their scripts, and they're much more likely to fill their grocery basket while they're there.
Okay, so let's look ahead to 2026. With the retreat from their own fulfillment centers, where is all that capital going now?
They are aggressively refocusing it. Kroger plans to accelerate new store openings by 30% in 2026.
30%. That is a huge commitment to physical retail.
It is. It's the flip side of the strategy. They're shifting capital away from those underperforming warehouses toward higher return, proven store projects.
Are they targeting new geographic areas with this push?
They are. They're expanding their Harris Teeter banner, specifically moving into the Jacksonville, Florida market. They plan to break ground on 14 new stores just in Q4.
Wow. What about internal shifts? Are they making changes to improve efficiency?
Aggressively. They're using AI for things like workforce management, they're improving procurement, and they made a notable cultural call, returning support staff to the office 5 days a week to improve collaboration.
Interesting. This focus on efficiency seems timely, especially with the legislative headwinds coming for their pharmacy business.
Yes, the Inflation Reduction Act. That's an important one. Starting January 1st, it's going to reduce Medicare drug prices on 10 major medications.
And that's going to hurt their sales numbers.
It will. They're projecting a 30 to 40 basis point headwind to Q4 identical sales.
So a hit of about 0.3% to 0.4% on sales. But how does that affect their profit?
See, that's the key part. Management was very clear. They expect no impact on earnings.
How is that possible?
Because the reduction in the Medicare price is fully offset by manufacturer rebates back to Kroger. So revenue goes down on paper, but the actual profit is neutralized. It's more of an accounting issue than a business problem.
That's a crucial distinction. Okay, finally, any update on the CEO search?
The search for an external CEO is progressing, and they expect to wrap it up in Q1 of 2026. They're clearly setting the stage for a new leader to inherit a cleaner, more flexible company.
So when you put this all together, what it really signals for you is a company prioritizing agility.
Absolutely. They are surgically shedding that expensive automation debt to focus capital on what they know works: physical stores and a smart, partnership-driven digital model.
The shift is a textbook example of responding to market reality, moving from a capital-intensive model to something much more flexible and asset-light.
They took that massive impairment charge to enable the change that boosts future operating profit by $400 million a year. It really highlights the decisiveness you need in retail today.
Exactly. They made a brutal $2.6 billion decision to enable a powerful $400 million annual profit improvement. Their betting partnership will outperform ownership.
And we shouldn't forget the tech layer here. They specifically mention leveraging things like agentic AI for the customer experience.
Right, like Instacart's AI-powered cart assistant. That points right to where this is all going. So here's a final thought for you to consider. Kroger has now funded this new, profitable e-commerce model with that massive write-down. How quickly do those personalized AI technologies move from being just a novelty to an essential, scalable profit driver that helps grow that $400 million goal even faster? That's what I'll be tracking in 2026.